Imagine you look at your bank account right now and you see a spare 20,000 ringgit sitting there. What's your immediate move? Do you use it to pay off your mortgage ahead of schedule, or do you pump it into the stock market or an investment fund? The answer isn't actually what most people think. Let's break down the math. Before you do anything, you have to frame this as a direct rate comparison. Think of paying down your home loan as a guaranteed return. If your current Malaysian housing loan effective interest rate is, say, 4.2%, paying it off early means you are instantly saving 4.2% in interest. That is a guaranteed risk-free return of 4.2%. On the flip side, look at your expected long-term investment return. If you put that money into something like ASB, EPF, or a diversified portfolio, you might be aiming for a 5% to 7% annual return. But here's the catch: risk tolerance. A 4.2% savings on debt is 100% guaranteed. A 6% investment return comes with market up and down. If the gap between your loan rate and your investment return is only 1%, is taking on that extra risk actually worth it to you? Let's walk through a simple side-by-side example with some round numbers over a 5 years period so you can see how this plays out. If you choose option A and throw that 20,000 into a 4% home loan, you stop the bank from compounding interest on that amount. You have saved roughly 4,000 ringgit in pure interest that you will never have to pay back. If you choose option B and invest it at a realistic 6% return, that 20,000 ringgit grows to roughly 26,800, and that's a gain of 6,800 ringgit. On paper, investing wins by a couple thousand ringgit, but remember, this assumes the market behaves itself for those 5 years. Now, math doesn't live in a vacuum. Let's talk about the real-world factors you must consider before making this decision. Emergency fund first. Never use your last 20,000 ringgit to pay down a loan. If you have an emergency, you can't easily pull that money back out of your house walls. Ensure you have 3 to 6 months of living expenses saved in cash first. Tax relief opportunities. Don't forget maximizing your EPF voluntary contribution, or PRS, also known as private retirement schemes, for those sweet tax relief perks before looking elsewhere. The psychological value. Never underestimate the mental peace of being completely debt-free. For some people, sleeping soundly at night knowing they owe the bank less is worth way more than that extra 1 to 2% market return. Loan structure in Malaysia. Check your loan type. If you have a semi-flexi or full flexi loan, you can park extra 20,000 ringgit in the linked account to reduce your interest without locking it away permanently. If you have a fixed or term loan, paying early might require formal notice or even incur penalties. Check your fine print. So when does early settlement wins? It wins if you value guaranteed peace of mind, or if your loan interest rate are high and market returns look shaky. But if you want to run the exact numbers for your own specific situation, you don't have to guess. I've actually built a free, easy-to-use home loan versus investment calculator over my website, keithwong.my. Just plug in your outstanding loan amount, your current interest rate, and your extra cash, and it will tell you exactly how much money you'll save or make over the next few years. Head over to keithwong.my right now to try out. The link is also in the description below. Smash that like button if this was helpful. Subscribe for more Malaysian personal finance strategy, and I'll see you over on the site.